Sanjeev Prasad, Senior Executive Director and Co-Head with Kotak Institutional Equity, joins us with his market take. Sanjeev, good morning and thank you for joining us. Sanjeev, last time when we interacted with you, you were slightly cautious. You made a case that valuations were looking slightly stretched, growth momentum will not make a comeback, and with the exception of IT and pharma, nothing was looking strong.
Well, things haven't changed that much, I would say. IT continues to do very well. If you look at the performance of the IT companies in the last 1 month, probably that was the time frame when we spoke. I mean, all the stocks have done really well. The domestic cyclicals, where people had a fair bit of hope post the outcome of the last state elections, they haven't done that well. In fact, many of them are down from the high levels you saw at that time. So at this point in time, we continue to stay with the same strategy, continue to be overweight on the outsourcing names, IT, pharma, some parts of auto, some of the domestic import substitution plays, those kind of companies. And as far as consumption and investment themes go, we continue to be light over there.
Sanjeev, it's not Rahul Gandhi, definitely for the Prime Ministerial, candidate from the Congress's side. But how are you reviewing, the emergence of AAP and how it's really catching fire? Do you think even a hint of a hung parliament, which the market is somewhere already working with, could be disastrous whenever the elections happen?
Well, I don't think the market is working with the premise of a hung parliament. This market would be 15% lower in that case. I mean, if you have a situation where you don't have a stable government post the national elections, so clearly, the market is going to come off quite significantly, because there will be concerns on economic reforms continuing, and economic reforms are imperative to push India to a higher GDP growth. And take advantage of India's demographics. So if that doesn't work out, then I think you could have a situation where you face a washout for a year or so. At this point in time, I think the market's best hope would be you see a stable government, which is either a BJP-led India or a Congress-led UPA. And if that is the case, then I think the market is on solid grounds. Otherwise, you could see a pretty serious correction in the market post the 2014 results outcome.
So what happens from here up until the run-up of the elections? Given the kind of macro data points that we've been running with, does it seem like this market is going to be a range-bound market? Perhaps 6,400, 6,500 is what we're going to see on the Nifty? Or do you think there is a possibility that the market could scale up way higher than that?
See, very unlikely, I would think, because if you look at the other factors which are driving the market, obviously they have to be linked to the broader, either let's say global economic recovery, where things seem to be on a reasonably good footing, and you have seen accordingly sectors doing very well. The outsourcing stories in India continue to do well. Now, when it comes to the domestic drivers, whether you take a look at inflation and monetary cycle, you look at economic recovery, you really don't get a lot of confidence that things are going to change in the next 3-4 months. As far as inflation is concerned, yes, headline inflation has come down significantly, but at the same time you have seen a marginal uptick in core inflation in both WPI and CPI. So I suppose at this point in time the RBI is not going to react either way in terms of raising, very unlikely. And in terms of reducing the rates, I think it will hold for some time till you start seeing, firmer visibility on disinflation trends continuing, disinflationary trends continuing. And also, I think the RBI would like to wait and see, what is the outcome of the elections, whether you have a stable government. If you see a lot of fiscal reforms being announced, by the next government in the forthcoming budget in June, whenever that is presented, then I think there is a case for maybe a rate cut in the second half of the next fiscal year. So I don't think monetary cycle is going to provide the trigger. Coming to economic recovery, you are seeing the numbers that are coming out. Last IIP numbers, disastrous, absolutely minus 2.1. You look at the monthly sales figures of autos, cement, steel, etc. Obviously no sign of any recovery over there. So there is no real trigger for the market, as far as domestic triggers are concerned. If you get positive data points out of the US, which indicates maybe a faster recovery in the US, and similarly, if that's the case in Europe, then maybe the IT companies could get, further rated. But other than that, I don't see much of many drivers for the market at this point in time.
Sanjeev Prasad, I wonder why you have a buy on Coal India.
It's a very cheap stock.
It has been a cheap stock. It could remain cheap for the longest time.
That is true, but the story is pretty simple. You look at the valuation of the company. If you adjust for the value of cash, the overburden removal and other income coming from cash adjusted for tax, this company is actually trading at about 7 times on a price earnings basis, so reasonably cheap. And also keep in mind the fact that it's still a company whose earnings can grow around 10% CAGR quite easily. You'll have about 4-5% volume growth. You take about 2 to 4% improvement in realizations. So you get about 10% top line growth quite easily for this company for an extended period of time. And most of the incremental revenue growth will actually straight flow to the bottom line. So it's a company which can deliver 10% PAT growth year after year very easily, I would think.
Sanjeev, Reliance is slated to come out with its earnings today. What's the expectations on the GRM front, and what prospects do you think Reliance would deliver when it comes to the petchem as well as refining margins?
Well, we are looking at about 52.1 billion rupees of net profit. I think we are slightly below consensus, about 53, whatever numbers I have seen on the screens. So it's going to be a slightly disappointing quarter compared to the previous quarter, primarily because refining margins have been fairly subdued. $7.5 a barrel is what we are looking at. But having said that, refining margins have improved quite sharply in the last 2-3 weeks, so this quarter should look better. More important, you are getting a lot of good news out on the E&P side finally, with respect to both the price increase, which has finally been notified, and also like the increase in production through the next fiscal year. So that should allay a lot of concerns on the E&P side. So as far as Reliance is concerned, I think value should look quite okay over there.
Where is TCS? And now, unlike Infosys and HCL Tech, TCS has cracked after numbers. Now, there are a variety of reasons why TCS correct. First, the run-up had been quite extraordinary. B, what they reported for the quarter gone by in terms of an, relative comparison, the sequential growth is much lower than Infosys and HCL Tech. An expensive stock, good franchise, but somewhere I think lofty valuations and the recent run-up could really restrict the upside for TCS. Sanjeev Prasad, are we on the same page? Are you with me when I say that for TCS the upside is restricted?
Yes, see, our fair value for TCS is 24 times. The stock is already trading at about 20 times on March 2015 basis. You compare that to something like Infosys, which is slightly below 17 times on, say, March 15 basis. Wipro is more like 16 times. HCL Tech is even cheaper. So I suspect what you are seeing here is maybe people taking a slightly more positive call on the other tier 1 names at the expense of TCS currently. Having said that, TCS I think will continue to deliver well into the next 2 years, given the fact that US economic recovery looks very strong, and IT spendings will improve. TCS execution is absolutely fabulous. So I see no reason why one should be panicking and selling the stock or anything. It should continue to be a part of the core portfolio.
Sanjeev, how would you approach the telecom pack, especially after the move in the entire sector once Reliance Jio decided to join the bandwagon for the 2G auction, and fears as to how that's going to intensify competition?
Well, we are positive on the telecom space, and we will look at buying the stocks given the correction which has taken place on fears of aggressive competition in the sector arising from entry of Reliance Jio. let's wait and see. I think it would be pretty foolhardy for any participant, no matter how strong the balance sheet is, to come and blow up in terms of acquiring bandwidth at, or spectrum at very high prices. The telecom market just does not support so many players, and if you have very high costs, obviously then the required, revenues, etc., all go up quite significantly if you have to make any viable investment case. So I suspect, at the end of the day, the pricing of telecom spectrum is going to be fairly rational. People will bid based on their economic considerations rather than, trying to disrupt the market, etc. So we are betting on a lot more rationality in the market. The balance sheets of most of the companies just do not support any aggressive either, let's say, price competition or bidding aggressively for telecom spectrum. So our view is that this is probably a good opportunity to accumulate both Bharti as well as Idea.
Sanjeev, but your peer brokerages are also of the view that Indian telecom business at the end of the day is a commodity business. An entry of a new player will obviously destroy the pricing power, and if pricing power gets destroyed, margins will come under pressure.
When you look at the history, there is a number of dead bodies littered in the telecom sector. Everybody has tried that strategy. What is the end game? The end game is you have several companies who are absolutely limping. The only reason why they are surviving is the largesse of the Indian banking system. Most of these companies are sitting on anywhere from $4 billion to $7 billion of debt, and absolutely no EBITDA to support that. Debt. So, why should these companies even be in existence? I still don't understand. And what is the business strategy over here? If it was so easy that you come and destroy pricing for some time and assume that you will gain market share and will be the top dog, I don't think it's worked out in the last 10 years. So why should we assume that it will work out the next time around? So I think, somewhere that rationality has to dawn on to players that this is not a market for 10, 12 players. You tried your stuff, you failed, you get out, and let the people who know how to run the business continue to run the business, So that's the basic limited point over here. Anybody who's trying to do irrational pricing will not make any headway into the telecom sector. You could maybe hurt the financials of the incumbents for some time, but at the end of the day, are you really gaining anything out of it? The answer is no. So, what is the point of having an aggressive strategy? That's the limited question which any fresh investor now has to ask in the telecom sector.
Well, TCS, by the way, has posted its worst percentage fall since October 17th, and the stock is now cracking almost 3.5% as we speak. The Nifty lying absolutely quiet. Sanjeev, should the dip in TCS, or rather the weakness in TCS today, be used as a buying opportunity?
As I said, it's a good company at fairly pricey valuation. So, it's not as if you need to hurry and buy everything today. If you look at the kind of upside we are looking at, fair value is 2,400 on a 12-month basis. So, if you want to own the stock for 6-7 months, maybe the stock is not going to give you a lot of return. But if you are looking at the stock more on a, let's say, 2-year view, the upside is still there, in the sense whenever people start focusing on 2016 earnings, then there is some money to be made. But in the meantime, I assume the stock will just fluctuate around 2,300 rupees for some time. Do remember the stock is not very cheap at 20 times 2015. A lot of good news is already there. So either you see some surprise on US economic GDP recovery, which results in some amount of earnings increase for the companies, or basically you wait for roll forward to 2016.
Sanjeev, would you be a contra buyer in Ranbaxy?
Well, I don't have much of a view of that stock, to be honest with you, given the fact that there are so many recurring issues which are of a non-recurring nature. I don't know how to put this, but it's very hard to figure out what exactly is the core earnings of this company, and how do you value this company in that case, because every few weeks you have some issue or other cropping up. So and then on top of it you have a lot of issues related to foreign currency. Honestly, I don't really have much of a view on that stock.
So at the current juncture, where are you contra buyer? Because the obvious trade is pharma and IT, which is a crowded trade. But some would also argue that maximum money will be made in contra buyers and for investors who are ready to buy into some risky names.
Well, I would recommend looking at some of the downstream companies like BPCL. And the thesis for that is simple enough, unless until the government comes and complicates it like it does every time. So if you look at 3-4 factors over there, one is the fact that we are looking at softer crude prices in fiscal 2015 compared to in fiscal 2014. Or on a calendar year basis, if you look at numbers, we are looking at fairly large incremental supply of oil from non-OPEC countries, about 1.7 million barrels per day, primarily coming from the US, about 1 million barrels per day. Compared to that, the incremental oil demand is somewhere about 1.2 million barrels per day. So clearly there is a case for lower crude prices for the current calendar year. If Libya situation improves further, it's already producing about 600,000 barrels per day. If South Sudan issue gets resolved and Iran eventually signs an agreement with the UN and other countries for the nuclear deal, then I suppose crude prices are going to be fairly soft. So that's one big positive for the sector as a whole. The second thing to keep in mind is we are seeing monthly diesel price increases. That process has continued irrespective of the state elections and the outcome of state elections, and hopefully whichever government comes to power will continue this process. One of the issues here is that the fiscal situation of India is pretty grim, and next year is going to be fairly challenging because food subsidy bill is going to increase quite sharply because of Food Security Act, and also fertilizer subsidies are going to increase because of higher gas prices. So the only way to manage fiscal numbers next year is to cut fuel subsidies. So whichever government comes to power has to continue with diesel price increases. So
right. Okay, Sanjeev, good having you on the show. I'm afraid we're completely running out of time. Good to have you on the show as always.